Hello everyone, welcome back. We are continuing with monetary policy. We have almost completed with monetary policy, and it is very important that you revise all these things. Time and again I'll keep telling you that you have to revise, because see, now you might understand the concept of tax buoyancy. Now you might think that you know what it is, but after a point of time, when you, let's say, when you are studying geography, when you're studying history, when you're studying polity, when all other subjects will come, economy, uh, uh, the concepts will start to fade away in your memory, and they will start to fade away from your understanding as well. So you will know that I have read about tax buoyancy, but I don't know what it is exactly, or I don't remember what it is. So that should not happen. Or if it starts to happen, then please keep on revising. 1.5 chapter per day. Even if you revise that, within 20 days you are done with one revision. 20 days you are done with one revision, right? So let us quickly revise what did we see till in monetary policy till now, and then we'll continue with the remaining part of monetary policy, and after that we'll start a new chapter, right? So very important, what is monetary policy? Who is the Monetary Policy Authority of India? We know RBI is the Monetary Policy Authority of India, right? We also saw that RBI, let us skip the history for now about Hilton Young Commission, about SBI, which was called as Imperial Bank of India, and nationalization, etc. So now we'll quickly go through what are the quantitative tools of credit control. Remember, RBI controls credit, it does not create credit. Who creates credit? Commercial banks. Commercial banks create credit. RBI controls credit. So what are the quantitative tools of credit control? ठीक है, RBI controls credit. What are the quantitative tools of credit control? First and very important tool is the repo rate. When RBI changes the repo rate, what happens? If RBI increases the repo rate, it makes it difficult for banks to borrow money from RBI. ठीक है, it makes money costlier from it makes money flow to the banks costlier, and hence banks find it difficult to give loans to the people at a cheaper rate, and hence they also have to increase the rates. Same goes with reverse repo rate, the rate at which RBI borrows money from commercial banks, or the rate at which commercial banks deposit their money with RBI is reverse repo rate. If reverse repo rate increases, then it makes it more attractive, or it becomes attractive for commercial banks to keep money with RBI, and hence less money is flown into the economy, right? Then we also saw targeted long-term repo operations. Long-term repo operations, there are nothing but long-term operations, long-term lending by RBI to commercial bank, but for specific giving for if it is giving for specific sectors, then it is targeted long-term repo operations. If it is generally due to COVID and due to alleviate the impact of COVID and all, then it is long-term. It is not targeted. It is long-term repo operations, right? Then we also saw everything about CRR and SLR. Let us quickly revise CRR and SLR. CRR is cash reserve ratio. SLR is statutory liquidity ratio. All these form part of fractional reserve banking. Yes or no? See, there are many parts of fractional reserve banking. These two are the major ones, CRR and SLR. So banks also have to keep some portion aside for other purposes also, but that becomes too much in depth. We are not going there. So CRR and SLR are the two main components of fractional reserve banking: cash reserve ratio and statutory liquidity ratio. Cash reserve ratio is covered under Banking Regulation Act. Yes or no? No. Cash reserve ratio is not covered under Banking Regulation Act. It is covered under RBI Act. Or RBI Act gives the statutory power to RBI to use cash reserve ratio as a tool of fractional reserve banking, as a tool of credit control, right? What is cash reserve ratio? Cash reserve ratio is banks have to keep certain percentage as cash, as hard cash aside. So always remember, hard cash does not mean physical cash. It can be in your account also. Your account also is known as cash only, right? So it does not mean that there is a go down and there is cash and every day people are coming in and going out depending on the deposits, how much they are coming. ऐसा नहीं होता. It is all automated. It is all in computerized systems. So balance is maintained. A separate CRR account is maintained in the bank's books of accounts, in the commercial bank's books of accounts, right? And then that cash is remitted to RBI, right? Cash is maintained by banks, but it is held with RBI. Then only cash. There is no other securities allowed in CRR. Then RBI does not give any interest on cash, on the cash which is kept as CRR. Then it is under RBI Act, and it suggests short-term intention of RBI. In short term, if RBI wants to change rates or change the amount of credit available in the economy, short term it will alter the CRR, right? Then coming to SLR. SLR is under Banking Regulation Act. SLR is statutory liquidity ratio. So three things you can remember, that three things are allowed. There are various other things also, but three are the major things. One is cash is allowed to be maintained under SLR. Second, gold is allowed to be maintained under SLR. Third, government securities are allowed to be maintained under SLR, right? Government securities also we saw T-bills, government bonds, SDLs, state development loans, etc. Okay. Now why they are called SLR? Because of the word liquidity. So these securities or these avenues of investment, cash, gold, and government securities. These are easily or readily convertible to cash. There is a ready market for government bonds, right? So you can, so if you have bought a government bond and if you're holding a government bond tomorrow, you can sell it immediately in the market. You will find a buyer. So that means that it is liquid. That means that there is ample liquidity in the economy, right? Then then we saw that SLR में Banking Regulation Act में there is power. हाँ, very important part of it, that SLR securities are kept with the bank itself. Bank invests money in government securities, so the government securities are with the bank. It is in bank's possession only. There is no RBI or there is no government involved. The cash and gold which is kept as SLR securities are also with the bank itself and not with RBI or any other entity. Then very important, there is no floor or no ceiling limit on CRR. So CRR can be 0 to 100%. We also saw that during demonetization for those 2-3 months, CRR was 100%. That whatever cash was collected as deposits by the commercial banks, and that had to be maintained with RBI as CRR to the extent of 100%. So entire cash had to be deposited with RBI. Temporarily, RBI could not hold this much amount for a long time, and hence RBI approached the government, and government said, let us open a new window, and you as my agent, you operationalize the window. And that window was called as dash. What was that window called? Try to remember. What was that window called? That window was called as Standing Deposit Facility, 2018. It was opened in 2018, Standing Deposit Facility, right? So in Standing Deposit Facility, who gives money to whom in Standing Deposit Facility? Commercial banks give money to government, and government issues the Standing Deposit Facility bonds, right? What is the act of sucking out foreign liquidity from the economy and giving bonds against that known as? It is known as sterilization. If you remember, it is known as sterilization, right? Sterilization is nothing but you suck out excess liquidity from the economy, and against that, when commercial banks say ki, okay, we are giving you the money, we are not lending it out to the people or in the economy, we need something. Government says take these bonds. These bonds you can exchange amongst themselves whenever you want. At the time of maturity, whoever is holding the bond last will come to me, I will pay him money. And whoever is holding the bonds throughout the period of time, today you are holding, tomorrow you sold it to someone else, according to the holder, I will pay the dividend to the holder, or sorry, I will pay interest to the holder of the bond, right? Then SLR mein there is no floor, but there is a ceiling of 40%, right? Tomorrow if government wants to move or wants to set the SLR more than 40%, then it will have to amend the Banking Regulation Act, and then only RBI can be, which RBI has been vested powers in Banking Regulation Act, and then only it can set the SLR more than 40%. This is very simple, very easy, sir, understood, sir. So my question is, if RBI wants to follow a cheap money policy, then will RBI raise CRR or RBI decrease CRR? If RBI wants to follow a cheap money policy, think about it and tell me. I'll give you a few seconds, because these are the kind of questions which are asked by UPSC, especially in the prelims exams and in the mains also. When you are saying ki, when you are saying ki growth has to be increased, or economy has to grow. So what are the ways in which economy can grow? So you have to increase money supply, you have to increase consumption, you have to increase investment. But how does RBI do that? By increasing CRR or reducing CRR? So if RBI wants to follow cheap money policy, which means money doesn't care about money. So if money flows to the economy, it is not affected that much by it. It says, okay, give it, fine, take it away. So RBI will reduce CRR. RBI will reduce CRR, which means more and more proportion of deposits is left with the banks to lend it away to common people, and hence money flows to the money economy. Money adds to the money supply stock. Okay? Then we go to, then all the CRR and SLR, what are these? A part of percentage of what? CRR is 4% of what? Of not deposits. We saw a fancy term for it, net demand and time liabilities, right? Net demand and time liabilities. Why net? Because that bank would have some deposits of its own with some other bank also. So you reduce those deposits for calculating CRR. Then why time? Why demand? Because I told you current account and savings account are together called as demand deposits, because you can withdraw them on demand. On your demand, you can withdraw them anytime you want. I know in savings account there are some minimum balance restrictions, but you can still withdraw them by paying penalty, but largely they are freely available. Okay? Apart from minimum balance, you can withdraw them anytime you want, but you cannot do so in case of fixed deposit or recurring deposit, because you will have to incur a huge penalty for that. So that is why fixed deposit and recurring deposit accounts are known as time deposits, because they are time dependent, because they are they mature, or you can use them after a certain point of time only, and if you want to use them before the passage of time or before the completion of time, then you have to pay a heavy penalty. Hence they are known as time deposits. So net demand and time, so we understood. What about liabilities? I always told you liability carries itself a burden. So when we receive a loan as central government, let's say we receive a loan from World Bank, not grant, we receive a loan from from World Bank as central government, it will fall under which of the heads? Capital receipts, revenue receipts, capital expenditure, or revenue expenditure? It will fall under capital receipts, because we have received a loan. We don't receive loan every day. It is of a big amount, and it results in after capital receipts, what it is? It is a debt creating capital receipts or non-debt creating capital receipt. It is definitely a debt creating capital receipt. Why? Because it is borrowing. Yes or no? We have taken a loan. We have borrowed from someone. So it carries with itself a burden. And I told you, whatever money you receive, if it carries with itself a burden, is called as a liability. So liability is created, you have to repay the money back to World Bank. Similarly, here also when we talk when we talk about deposits received by commercial banks, then that is nothing but a burden which the commercial banks carry. You have deposited your money with the bank, your life savings are with the bank, and banks have the responsibility to protect it, to keep it secure, and to give you interest also. So that is a burden for the bank, and that becomes a liability. So out of these entire total deposits collected in the economy, out of total money which is received by commercial banks, some percentage have to be net, some percentage has to be kept as CRR, some percentage has to be kept as SLR, right? So that is why these are called as liabilities. So net demand and time liabilities, very fancy word, but it is simple. Okay. Then after that, quantitative tools we saw that quantitative tools increases or decreases the pie of money supply or the quantity of money supply, right? So you order a bigger pizza or you order a smaller pizza, but you don't decide who gets to eat how many pieces. You don't get to decide who one piece, or you don't get to decide how many pieces are there for one person. So then you move on to qualitative tools of credit control. What about qualitative tools of credit control? Quality means you change the direction, you change the way the credit is given. So let's say if you want to encourage one particular sector, then you will set rules. You as RBI will set rules in such a manner that the credit card direction changes. So first tool was margin requirement. So like I told you, if you set a higher margin for something, if you set a higher margin for a sector, then lower credit would be available to that sector. And if you set a lower margin, or if you lower the margin, then higher credit would be available. Second most important thing was priority sector lending. Priority sector lending means what? You add certain list of sectors where credit has to flow compulsorily, and banks have to mandatorily out of the total loanable funds, out of the funds which they are ready to give out as loan, certain percentage has to be given to these sectors, and then rest they can give to other sectors as they wish, right? So these are known as priority sectors: agriculture, health, education, renewable energy. So many sectors are there in priority. Approximately 40% of total loanable funds have to be given as priority sector lending, right? So we saw another term for total loanable funds. A fancy term was average net bank credit, ANBC, right? Average net bank credit. So average net bank credit में क्या होता है? It is average of your total loanable funds which you take, and net bank credit मतलब कि net after deducting CRR, SLR, whatever is your net funds which you can loan out, उसका certain percentage you have to give to priority sector lending. Then third thing that we saw was moral suasion. We saw dhamki, right? Warning, threatening by RBI to the commercial banks, please follow these norms, or please follow whatever we are saying, otherwise we will take the fourth option, which is direct action. We will take direct action against you, right? This was what we saw about qualitative tools of credit control. Then I hope you know the 4 regimes of loan giving: discretionary, base rate, MCLR, and external benchmarks. Okay. Then what else did we see after that? What else did we see after that? After priority sector and after qualitative tools of credit controls, what else did we see? We saw something very important. We saw the heart of monetary policy, which is Monetary Policy Committee 2014, Urjit Patel Committee. What were the recommendations that we see in the last lecture? First recommendation was that fiscal deficit should be reduced, right? Second was there should be a Monetary Policy Committee headed by RBI Governor. Third was that थर्ड क्या था, that inflation should be targeted. Which inflation should be targeted? Combined headline CPI or combined CPI headline, whatever you want to call it. ठीक है, that inflation has to be targeted. And then fourth point was the inflation target should be 4 plus minus 2%. Then we saw monetary policy framework was signed in 2015. Monetary policy committee came into being. There are 6 members of monetary policy committee, 3 from RBI, 3 from government. Out of 3 members of RBI, 1 is governor, who is the head of the monetary policy committee, and deputy governor in charge of monetary policy also sits on the monetary policy committee, right? Then how are decisions taken? Decisions are taken by majority, but if there is a tie, then governor has a casting vote. Remember, decisions are taken by 3/4 majority in GST council, but decisions are taken by majority in monetary policy committee. So do not confuse between them, and do not get confused between them. Then what else did we see here in monetary policy committee? That they are appointed for 4 years. They are not eligible for reappointment. MP MLAs are not eligible to be appointed. We have a bi-monthly monetary policy system. We have a semi-annually monetary policy review system. Every 6 months monetary policy review comes out. Every 2 months monetary policy committee meets, and they set the target. And then we also saw that minimum 4 times, so they have to meet in a year, right? Then what else did we see regarding monetary policy and everything? 4 plus minus 2% is a medium term target. These terms are very important, right? Whatever I am telling, these words are very important. Then it said the medium term target. What about medium term target? It was initially for a period of 5 years, which got over in 2021, and then for next 5 years we have the same target, 4 plus minus 2%. Now my question is, what happens if RBI is unable to achieve the target or unable to meet the target? Then it has to give explanation to the government and to the parliament why they are unable to achieve, and then accordingly further action can be taken, what to do, how to solve this problem, etc. Okay. Then we saw very important things, that we saw the stances of monetary policy: accommodative stance or tight stance or neutral stance, right? So then we know that accommodative stance is taken by the monetary policy committee when it is willing to give rate cuts. Who is demanding rate cuts? Corporates and borrowers. Basically, borrowers and investors are demanding rate cuts. Why? Because they need funds at lower cost so that they are able to expand their business, so that C+I increases, okay, and GDP increases. But if there is already high inflation, then RBI will not allow such rate cuts to happen, or RBI will send a direction to the banks or to the corporate borrowers that we are not ready to cut rates yet, and hence they will have a tight monetary policy stance, right? So tight monetary policy stance is usually when inflation is at a lower limit or inflation is at a higher limit. Inflation is at a higher limit. Why inflation is at a higher limit? Because uske aage inflation they are not allowed to go, and they don't want inflation to go further. And if they cut rates, then more money supply will be available in the economy. Banks will lend out more, corporates will borrow more, they will invest more, they will spend more, GDP will grow more, and that we don't want, because there is already high inflation in the economy, right? So that is why they have a tight monetary stance. When is accommodative monetary stance available? When they have to give a boost to the economy, when they want economy to grow, when they want even at the risk of inflation going a bit higher, they are okay with that because growth takes priority. That is when they have an accommodative monetary policy stance. Is this clear? So far so good. So now we know that there is a very big dilemma between growth and inflation. Yes or no? Growth bhi chahiye and price stability bhi chahiye. So when I say price stability, is nothing but low inflation. It is nothing but low inflation, hai na? Price stability means low or jitna whatever we need, utna inflation. Okay? So this is the constant dilemma which RBI faces. We also saw on the RBI website that the preamble of RBI says the same thing, that it needs to maintain the monetary policy stability, financial stability, while also taking into consideration the target for growth, right? So this is a dilemma, or this is a very tight space where monetary policy committee operates. So they have to consider all the factors. We also saw the minutes of monetary policy committee, who votes and who voted yes, no. And recent monetary policy, what was their stance? Their stance was accommodative stance, but currently they did not cut any rates, neither increased any rates, but there was accommodative stance, which means, and this was in June. So when August monetary policy will happen, there is a high probability, not always, but there is a high probability that they will cut the rates. Okay? Now let me tell you one very important thing in newspaper when you will read all this. So you will read that monetary policy committee cuts rate by 25 BPS. Now what do you mean by 25 BPS? Any idea? So this is basis points. ठीक है, this is known as basis points. So 100 basis points is 1%. This is called as BPS, right? So when I say, so current CRR is 4%, suppose when I say RBI current repo rate is 4%, when I say that Monetary Policy Committee cuts repo rate by 25 BPS, which means nothing but 0.25. So the resulting repo rate would be 3.75%. Samjha? So keep this in mind. This is something very important because we need to understand this. 100 basis points is 1%. 100 BPS is 1%. Okay, so when we say 25 basis points, it is quarter of a percentage, 0.25%. So you will read in newspaper that before COVID and now till date, RBI has cumulatively reduced the CRR or cumulatively reduced the repo rate by 200 basis points, which means at different points of time, total milake 2% has been reduced, which means if today it is 4% and before COVID it was 6%. Aisa you can understand all these things. Okay, just write this down because I will just erase this slide because it's only one thing. What do you mean by potential GDP? What do you mean by potential GDP? Potential GDP is nothing but GDP that India or GDP that any country or any economy can achieve without significant increase in inflation. That is potential GDP. What is the difference between current GDP and potential GDP? It is called as output gap. Okay, please revise, please revise. I am telling constantly that you have to revise each and every lecture that you are getting on the portal. You have to revise it and you have to be very thorough with the concepts, right? What is tax expenditure? Tax expenditure is all the exemptions and deductions and concessions given by the government, that is called as tax expenditure, right? Then we also saw a debt to GDP ratio. What is the target of debt to GDP ratio by encasing review committee? It is 60%, 40 for central government, 20 for state government. 60% of what? 60% of government debt. Remember we saw government debt. What are the components of government debt? Borrowings, internal, external, then debt against public liabilities, which is against public account of India. What was the article number for public account of India? Article number for public account of India was article 266. Consolidated fund of India is also 266 and contingency fund of India is 267. So 266, 266, 267. These are the article numbers. Under which article is budget presented, and is budget called budget or something else in the constitution? Budget is called as annual financial statements. It is article 112 of the Constitution of India. Okay, you need to know all these. These are very basic things because if you don't know these things, then you cannot reach or you cannot study about the advanced levels or advanced economics which come in newspapers or which come in survey. So, before reading survey next year, when survey will come in Jan, before reading survey, you need to be very clear with all the concepts. In fact, survey is a very technical and very advanced document. So, you need to be clear with these things because survey will not go in explaining ki why is RBI reducing CRR, why is RBI reducing repo rate. Survey will assume you know that, and uske aage survey will tell the analysis ki by reducing these were the factors taken into consideration. But why are we reducing that that they will not tell. Okay. Then very important aspect we are coming, but before that we also saw that what kind of securities can government issue. So can state government issue short-term securities? State governments cannot issue short-term securities. Can central government issue long-term securities? Central government can issue long-term securities. Central government can issue both type of securities, short-term and long-term. Central government short-term securities are called as government bonds. Yes or no? No. Central government short-term securities are called as treasury bills. Central government long-term securities are called as government bonds. What are state government long-term security called as? They are called as SDLs, state development loans. Then after going to the market, they go to RBI. RBI gives something. What is that called as? What is the window called as? I had written in pink here. What is the window called as? It is called as Ways and Means Advances, WMA. Okay? Is the normal WMA available for both center and state? Yes, normal WMA is available for both center and states. What is normal WMA? Does it ask for security or does it not ask for security? Normal WMA does not ask for security, hence it is also called as clean loan or unsecured loan. Okay, it is a risky loan, it is an unsecured loan. Special WMA is over and above normal WMA. Who can approach it? Only states can approach it. Okay, only states can approach it. And does RBI demand security from them? Yes, RBI demands security from them. So it is not a clean or not an unsecured advance. Is it for long term or short term? It is for absolutely short term, and it is carried at repo rate. Samjha? It is carried at repo rate. Now I am going to teach you something which I need your attention for, because this is very, very, very important. Okay. What will in fiscal policy, not monetary policy, in fiscal policy, what will government do? What will government do if government wants to pursue, or if government wants to pursue high growth, or if government wants to pull the economy upwards? What would government do? Would it increase taxes or reduce taxes? It would reduce taxes, correct? It would absolutely reduce taxes. Okay. What would monetary policy RBI do? It would reduce rates, be it repo rate, be it reverse repo rate, be it CRR, be it SLR. It would reduce all these rates. Okay. Now my question is, what would happen if even after reducing these interest rates, even after reducing SLR, even after reducing CRR, boosting doesn't happen? What if government doesn't, or sorry, what if economy doesn't get uplifted, or government doesn't, why I'm saying government, or economy doesn't result in growth, or growth does not happen in an economy even after reducing rates? See, rates kitna reduce karenge? It is already 4% today. Yes or no? It can go to 3, it can go to 2, but what after going to 2 or after going to 1? What will happen if economy doesn't rise? What will happen if spending doesn't rise? What will happen if people still don't get loans? What will happen if people still don't spend? What will happen if prices still don't rise, economy still does not grow? That is a very big problem, and that happens very often in developed economies, and that happens rarely or occasionally in developing economies also. Okay? So now what is happening is, this is a graph, right? This is interest rate, and so interest rate is falling, and this is time. So you have reduced interest rate over a period of time. You are reducing. So let's say this is 6%. You reduced it to 5%, 4%, reducing. But still, economy is not going up, because ideally, when you reduce interest rates, economy should go up. Economy should go up because you are following an expansionary monetary policy. You are following a cheap money policy. You are following. You are encouraging them to take more loans. You are encouraging them to borrow, to spend, to invest, to consume. Yes or no? But still this is not happening. See, after a point of time, it can result in 0%. But what if even at 0% people don't spend, or what at even 0% people don't borrow? Okay? So this is a very big problem which is faced by central banks. This is a very, very, very big problem which is especially US Federal Reserve and developed economies face this problem. What happens? So this particular scenario, why this happens, we'll see why this happens, and then we'll see what is it called as. So why this happens is, I'll give you a very simple example. You want to buy a laptop worth rupees 60,000 online, or offline, okay? You go to the shop and you do your research, right? What is the RAM, how much is the hard disk, and what is the screen size, whether it is touch screen or not. You see which shop is giving you better prices, whether online it is available at a cheaper price, or offline also which shop is available at a cheaper price, online also Amazon or Flipkart or someone else, right? So you do all that research, and then you saw that yesterday the laptop was priced at 62,000, today the laptop is priced at 60,000. Okay? Would you buy it today, or would you wait 2-3 more days to see whether the price goes down further? You will wait for 2-3 days, unless it is very urgent. You will wait for 2-3 days. So let's say tomorrow you notice that it has gone down to 58,000, and day after tomorrow you see that it has gone down to 56,000. So what will you do? You will still wait, you will not buy. Yes or no? Exactly, that is what is happening here. People wait for further reduction in rates. You go to buy a home loan, sir, 8%. Tomorrow you go to buy, sir, 7.8%. Day after tomorrow you go to buy, sir, 7.6%. उसके बाद you go, sir, 7.5, 7.1, 7.0. You will not take the loan until and unless rates start increasing or rates remain constant. Yes or no? But from that journey from 8% to 7%, RBI has already cut rates a lot, many number of times. And there is a point in time where, let's say it is at 1%, suppose. Now it cannot cut rates. ठीक है, इतना तो चाहिए, 1% तो you need basic to keep banks in check and all. So 1% you keep. So ऐसा हो गया है. But people are still not borrowing. Growth is still not happening. Growth is still very constant. So if I map the growth here, then growth early, it should happen like this, but it is also at a very constant pace. So it should go up because rates are coming down, but growth is still like this. Okay? This happens because people expect rates to go down further and they don't borrow. So yesterday if rate was 8%, today it is 6%, still you will not borrow because you expect rates to go down further. Simple. Okay? This situation is called as, in economics, this situation is called as liquidity trap. Why liquidity trap it is called as? Because in economy liquidity is not there. People are not borrowing, people are not spending, people are not investing. Why it is a trap? Because people even after reduction, people expect further reduction. Okay? Even after reduction, people expect further reduction. And that is why economy does not pick up. And when economy does not pick up, you have to cut rates further. But when you cut rates further, economy still does not pick up. And after a point of time, you are like, bas ho gaya, ab mujhse nahi hoga. This is known as liquidity trap. It's a very important concept. Okay? This is known as liquidity trap. Samjha? Now what do central governments do? Or what will RBI do in this case? So we discussed about quantitative tools of credit control, CRR, SLR, bank rate, repo rate, MSF rate, whatever. So all these rates, even if you reduce all these rates, growth is not happening. So rates are now almost near 0%. Yes or no? All rates are almost near 0%. That is why this situation is also called as you are bound towards a lower end of the rate system near zero. That is why it is also called as zero lower bound. So liquidity trap is also called as zero lower bound. That condition or that situation is also called as zero lower bound. Now what would you do? See, we are in monetary policy. So now what would central bank do? What would RBI do in this case? Rates as tools over. Okay? You cannot further reduce rates. So rates ka kaam to ho gaya. Rates are no more an option. Reducing rates, cutting rates is no more an option now. Now what can be done? What else can be done now? Growth karna hai. Now what else can be done? Remember, after rates, but before going to qualitative tools of credit control, we discussed one thing where RBI interacts with the public directly. What was it? What was it called? Open market operations, remember? So when this does not happen, see, this is when RBI is dealing with banks, remember? So when RBI is dealing with banks, nothing is happening. So then RBI steps out of its comfort zone and RBI calls people directly, ki, sir, why are you not borrowing? We have reduced rates for you, why are you not? So you say, ki, sir, we are expecting rates to go down further. Okay? So what will RBI do is that RBI will ease up its open market operations. Ease matlab kya? So RBI has a strict policy of buying only certain kinds of government securities. Remember, I had spoken to you about credit rating. Do you remember? We had spoken about 5-10 minutes on credit rating. Every country has a credit rating. Every instrument has a credit rating. So the higher the rating, the better it is. Okay? So government or RBI has a policy of buying in open market operations, buying only those government securities which have a high credit rating. Okay? Because they are liquid, they are of good quality, they are backed by sound reserves and etc. In open market operations, when RBI is buying, what will happen to the money supply? In open market operations, when RBI is buying, what will happen to the money supply? It would increase. When RBI is buying, it will give cash to the people and then money supply increases. When RBI is buying securities from the people, it would buy securities, it would give cash to the people, ki enjoy, you borrow, you increase your consumption. So when RBI borrows or buys from the open market, then money supply increases. So it is following a cheap money policy. It is following an expansionary monetary policy. When RBI sells securities, it wants to suck out excess liquidity from the economy, and that is when we follow a contractionary or we follow a dear money policy. Okay? So here what will RBI do is that RBI will say ki sir, fine, I am giving you best offer. Open market operations mein, I am giving you a very good offer, sir. I will accept. I will see. So if RBI wants to increase liquidity in the economy, this is not working. So if it goes in OMO, if it goes to the people directly, what will it do? Will it buy securities or sell securities? It will buy securities from the people. So when this is not working, it will go to the people. It will tell people ki, sir, why are you holding securities? Take cash. Give securities to me. I am buying it. People will say, sir, but these are not high quality. The ones which you usually buy. RBI is very desperate now. RBI is very desperate to increase money supply. So RBI says ki chalega. Even if you have a lower grade securities, chalega. So RBI starts accepting lower grade securities which it normally does not accept. Lower quality, lower grade securities which it normally does not accept. Starts accepting lower grade securities. Okay? What is that one power with RBI which can instantly put money in the hands of people? What do you think? Is that one power in the hands of RBI which instantly puts a lot of... We discussed that also. Okay? If RBI does this, then there will be very high inflation. What was it? Printing currency. RBI resorts to printing currency. Ki growth nahi hai, there is no price rise, there is nothing which is happening, economy is stagnant. So RBI will print currency. Okay? RBI will start printing currency. Are you getting it? This is the tool in the hands of RBI which is scarcely used. But now it will start to print currency because it desperately needs growth, it desperately needs what we say, economy to be boosted. So now it will resort to all sorts of desperate measures. Okay? Now imagine you are standing here in Delhi, you are standing and you hear helicopter above you. Okay? You hear helicopter and there is an announcement which is being made कि we are dropping packets of money. Whoever will find it gets the money. They start dropping packets of money from helicopter. Just imagine. Okay? So this happened. This is a theoretical construct, but economists often suggest doing this. Economists often suggest ki print currency and hand it out to people, right? So this theoretical dropping of money by the government for free. Everyone, jo bhi aayega le lo. Whoever is there, you can take, and we are dropping money at various places. You come, you collect, and you catch the money, and you go and you spend. Okay? So this is nothing but printing currency only, but it has a fancy name in economics, which is called as helicopter money. Do you realize why helicopter money? It is called as helicopter money. Now why helicopter money? Because you are literally dropping it. So this is a theoretical concept, but it means nothing but print currency. Samjha? So can I say these are desperate measures? Can I say these are extreme measures which are not usually undertaken by RBI, but it will happen when you are in a liquidity trap? It will happen when you are in a zero lower bound situation. Yes or no? So these measures collectively, these desperate measures collectively are called as what was the desperate measure by government? Pump priming. Remember, just pushing in money, just doing everything in its power. So the pump priming equivalent of fiscal policy in monetary policy are these measures. These measures are collectively called as, what are they collectively called as? They are collectively called as quantitative easing. They are collectively called as quantitative easing, QE. So whenever you read that RBI is resorting to quantitative easing, it means that it is now desperate to boost growth. When quantitative easing happens, your growth starts increasing and it goes up. Now when your growth starts increasing, obviously you would also again increase your interest rates because abhi zyada ho gaya, now limit is over. So again your economy starts increasing. Understood? This is also a cycle. Remember, this is a cycle, economic cycle, right? See, I told you, you remember this diagram, right? Economic cycle wala diagram. So whatever point of time we are in the economy, newspaper articles will come accordingly. So if we are in this phase, lower phase, newspaper articles will say that we need to boost growth. If we are in this phase, if growth is high, inflation is high, it will say that we need to, curb our spending. We need to increase various rates, tax rates, interest rates, etc. Okay, this is very important. This is very, 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 very important. Liquidity trap, quantitative easing, zero lower bound, right? Very important thing to know is here what becomes ineffective. What becomes ineffective? Monetary policy becomes ineffective because rates are the main tool of monetary policy. So monetary policy becomes ineffective. So RBI will call up government and RBI will say, sir, you have to reduce taxes now. Whatever I could reduce, I did. But sir, now fiscal policy takes charge. So your fiscal policy is more effective, and these are desperate and exceptional measures. So when we are in a zero lower bound regime, RBI always picks up the phone and calls government ki, sir, now ball is in your court. Fiscal policy has to take precedence over monetary policy because your monetary policy is completely ineffective. This is not working, sir. Okay? It is simple to a doctor saying that this medicine is not working. Please call a specialist, and now it is his. He can try to make it work. And of course, these are desperate measures. So, cancer medicines or those which are harmful for the economy but necessary. These are all those desperate kind of things. Printing currency is never advocated, but in zero lower bound measures, it is absolutely required. What is monetary policy transmission? Rate cuts or rate increases transmitting to the people, transmitting to the common people, borrower ho, lender ho. Rate cuts, if they are getting the benefits of rate cuts or if they are suffering the burden of rate increases, then that means your monetary policy is getting transmitted. Okay? Now, very quickly tell me what will happen to interest rates. What will happen to interest rates? So you have to tell me interest rates decrease or reduce. Okay? Interest rates, what would happen if inflation is high? Would interest rates reduce or increase or decrease? Interest rates would increase. Okay? What about growth? What if growth is high? What would happen to interest rates? Interest rates would increase. What would happen if savings are high? Ulta socho, if interests are high, what would happen to savings? What about savings? See, interest is high, interest rate is high, okay? Which means it is very difficult for you to borrow, which means you will not spend much now, which means you will save more. So this is also direct, okay? What would happen if government's need to borrow is high? What would happen if fiscal deficit is high? Government need to borrow means fiscal deficit. What would happen if fiscal deficit is high? What would happen to the interest rates? What do you think? It would increase. Why? Because of crowding out. Because of crowding out. Fiscal deficit is high. Government is a big borrower. Government will borrow large chunk of funds. The remaining funds ka interest rates would increase. Yes or no? So please bear in mind that all these have a direct correlation with interest rates. All these have a direct effect on interest rates. Okay? Now we come to another important part of it. What would happen if this goes minus mein? What would happen if this goes minus, if the rate goes minus? What would happen if repo rate tomorrow RBI decides to make it minus 1%? What do you think is the impact of that? Minus 1%. What do you mean by minus 1% rate? Repo rate is minus 2%. What is the meaning of that? What is the impact of that on the economy? Repo rate is minus 1%. So means when commercial banks borrow from RBI, will they get interest or they'll have to give interest? When commercial banks borrow from RBI, I am commercial bank, I am borrowing from RBI, I am a borrower. So I will have to pay interest to RBI or give interest to RBI. I will have to pay interest to RBI or receive interest from RBI. If it is minus 2%, I am borrowing money from RBI and RBI is only giving me interest. Okay, this is a very unusual situation. I am only borrowing money and RBI is giving me interest. Imagine you borrowing money from HDFC and HDFC giving you interest. Normally you have to give interest to HDFC na, because you have taken a loan. But in this case, HDFC is giving you money also, HDFC is giving you interest also. Okay? This regime is called as, negative interest rate regime. This area where central banks, sir, does this happen in real life? Of course it happens in real life. It happens, absolutely it happens in real life. Negative interest rate regime happens in real life. If you were here, I would have asked you which country follows a negative interest rate regime regularly. But you are not here, so I can't ask you. The country which follows in reality, the country which follows in practicality a negative interest rate regime is nothing but Japan. Japan follows a negative interest rate policy, or you can say negative interest rate regime or negative interest rate policy. Same hai? Japan exclusively follows a negative interest rate policy. Now I'll discuss the impact of negative interest rate policy. Okay? Let us discuss the impact of negative interest rate policy. What is negative interest rate policy? What do we mean by negative interest rate policy? Mainly followed by Japan. It means that central bank is penalizing you to keep money with central bank. Central bank is saying borrow money from me and take interest also. Central bank is incentivizing borrowing money from RBI because it desperately wants to increase liquidity in the economy. ठीक है? समझा? So now tell me, very simple. I will put one more layer to this. Do you remember what we studied about real GDP and nominal GDP? What is the difference between real GDP and nominal GDP? What is the difference? Inflation is the difference. Yes or no? Same thing applies to interest rate, not negative. Chalo, negative to 2 minute ke liye forget. Same thing applies to interest rate. So when we are talking about repo rate being 4%, when we are talking, so let's say you went to HDFC and you ask HDFC, sir, how much do I get in savings account? HDFC says, sir, you get 4% interest, which means today if you deposit 100 rupees and let's say you keep it for 1 year, how much would you get at 4% at the end of the year? You would get 104 rupees. Yes or no? But let's say inflation rate is 10%, then what happens? Inflation rate is 10%, which means 100 rupees worth of purchasing power you are keeping in the bank. 104 rupees you are getting after 1 year. But is this 104 rupees equal to 104 rupees today? No, because it has lost its value. 10% value khatam, inflation. So things which you were able to buy at 100 rupees, today you are able to buy them at 110 rupees. So things which you were able to buy at 100 rupees, you might have gotten more at 104 rupees. But now 100 rupees ka hi value 110 ho gaya hai. Just imagine. So you have actually lost money here, yes or no? You have actually lost money here. Sir, how lost money? We have gained money 4%. You have gained money 4%, but you have lost purchasing power. Do you agree with this? Today if a chocolate costs you 10 rupees and you have, let's say, 20 rupees, you are able to buy 2 chocolates. But tomorrow if the price increases to 18 rupees, okay, you are able to buy only 1 chocolate, not 2 chocolates, right? So your money might increase, but your purchasing power reduces. This is the whole concept of inflation. Inflation takes away purchasing power from you. Inflation sucks out your money's value, your value of money reduces. ठीक है? So absolute value में you would have 10 lakh rupees in your bank account, but whether those 10 lakh rupees can buy things that were available for 10 lakh rupees before or not, that is the question. Very simple example I'll give you. Today homes cost 1 crore rupees, 2 crore rupees. ठीक है? 20 years ago homes costed 50 lakh rupees. Yes or no? 40, 50, 30, 40 lakh rupees में you got a decent home in a decent place, right? So your purchasing power has lost because of inflation. समझा? Best example I give of inflation is your cold drink bottles. If you remember, in my childhood, I remember half liter we used to get for 14 rupees, 1/4. Now, uska price has gone to 35 rupees or 40 rupees, I think, half liter cold drink bottles, right? This is inflation. Of course, cost is increasing. What are the reasons for inflation and all that will go into inflation chapter. But inflation always sucks out your purchasing power. Always remember this. So you deposited 100 rupees in a bank account is giving you 104 rupees at the end. But whether this 104 rupees has the same power as the 104 rupees today. So today if I give you 104 rupees, you are able to buy a lot of things. Tomorrow bank is giving you after 1 year 104 rupees. You will not be able to buy those many things. Why? Because your purchasing power has reduced. Your purchasing power has been reduced by inflation. So let's say 104 rupees mein you are able to buy only one thing now instead of previously 3 things. So your purchasing power has reduced. So net you have lost money, technically speaking. So you are very happy. Yes, I am getting 4-5% rate of interest. 100 rupees I am depositing today. After 1 year I am getting 5%, 105. But that 105 after 1 year is not the same as 105 today. Samjha? So it is always. So when will you gain money actually? So if I tell you interest rate which is given by banks and inflation, when would you gain money? So in the first scenario, interest rate is more than inflation, and in the second scenario, interest rate is less than inflation. When would you gain money? When would you gain money? When interest rate is more than inflation rate, because inflation is pulling your purchasing power down, interest rate is pushing it up. Okay, so net if pushing up is more than pulling down, then you gain money net. Okay, now let me take you to the concept of real and nominal. So let's say I have real plus inflation is nominal. Yes or no? ठीक है? So whatever interest rate we see, कि bank is giving 5% and all, that is always nominal interest rate which is quoted. So always remember, bank is giving you, let's say 6% rate of interest, but you know inflation is 4%. So how much is your real gain? Only 2%. Samjha? So bank is attracting you, sir, keep money with us. We are giving 6% per annum. You say, but sir, inflation in the economy is 4.5%. What is your real gain? Only 1.5%. Do you agree with this? Samjha? Real interest rate, nominal interest rate. Did you understand this? Did you understand what is real interest rate, nominal interest rate? Right? It is very important for you to understand all these concepts. Hence, just a minute. Hello? Right? ठीक है? समझा ये? Did you understand real interest rates and nominal interest rates? It's very important to understand this. Real interest rate and nominal interest rate. What is the difference? What is the difference between these two? Inflation is the difference, right? What happens in inflation? Your purchasing power reduces. What happens in inflation? Your worth of value of money reduces. Today, if you are earning 50,000 rupees and 10 years ago you were earning 50,000 rupees, you only tell which is better. Today earning 50,000 or 10 years ago earning 50,000. 10 years ago 50,000 earning was better because that time prices were so low that you could buy almost everything. But today in 50,000 per month you cannot buy a lot of things, right? Which means inflation reduces your purchasing power. See, in absolute terms of money you are earning the same amount, 50-50. But what is the value of that 50,000? That 50,000 is much more powerful than this 50,000. ठीक है? समझा? So now we are talking about real and nominal interest rate. चलो, now tell me When I talk about negative interest rate regime, when I talk about negative interest rate policy, which rate am I talking about? Nominal or real interest rates? I'm talking about real interest rate. So when I say ki repo rate is -2% in Japan, let's say, which means that the nominal interest rate is somewhere around 4%. Inflation is somewhere around 6%. So 4 minus 6 minus 2% goes the real interest rate, which means banks are actually losing money if they keep money with RBI. Yes or no? If they keep money with RBI, then banks are actually losing money, because not RBI, Japan's central bank, because Japan's central bank wants the commercial bank to give out money in the economy. Japan central bank wants the commercial banks to give out money, to loan out money. Now, why it is following this, I am going to tell you. Japan follows a negative interest rate policy very often. Why? I will tell you. Tell me, is negative interest rate causing excess flow of money in the economy? Yes or no? Yes, it is causing an excess flow of money. Now tell me, due to this, demand would increase or demand would decrease? Demand would increase a lot. Prices would increase or prices would decrease? Prices would increase a lot. Okay? Japan imports a lot of things. Okay? It is an island nation. Japan doesn't produce a lot of things. Japan imports a lot of things also. Now tell me, would the prices for imported goods reduce or prices for imported goods increase? Increase, because demand is increasing, prices are increasing. Okay? So prices for imported goods are now increasing. Now what do you think will happen to Japan's currency? Will Japan's currency become stronger? Yen would become stronger or yen would become weaker? I would write all these things, but yen would become weaker. Why, sir, yen would become weaker? Because you are importing things. When you import things, let's say they are importing from USA, when they are importing things, they would need to pay in dollars or they would need to pay in yen. When they are importing, they would need to pay in dollars. How do you get dollars? By giving up yen. Yes or no? So dollars demand is increasing and yen supply is increasing. Now what will happen to the value of dollar? Dollar's demand is increasing. What will happen to the value of dollar? Dollar will gain in value. And yen, you are pushing yen. So yen supply is increasing. Yen's value will fall down. Yes or no? So dollar becomes stronger. Yes or no? So Japan's currency yen becomes weaker. Agreed? When Japan currency yen becomes weaker, what do you think will happen to Japan's exports? Will Japan's exports become cheaper or Japan's exports become costlier? Some part of it is related to balance of payments, hence you might not be able to follow, but try to apply your logic. If I told you that Japan's currency is becoming weaker due to lot of imports, right? Then if Japan's currency is becoming weaker, what will happen to exports? When Japan's currency is becoming weaker in international market where every country sends its goods, basically when Japan is sending its goods, will those goods be cheaper or will those goods be expensive? Because Japan's currency value is very low now. They will be very cheap. Why cheap? They will be very cheap because Japan's currency value is very low. Okay? Now, what do you think will happen to Japan's demand for Japan's exports? Would it increase or would it reduce? Because now the Japanese goods are available at a very cheap rate. Demand would increase. Japanese exports would increase. Japan's entire economy is export dependent. Hence, negative interest rate. They want to sustain their exports. They want to increase their exports. They want to mainly fish and agricultural produce. They export a lot of fish and agricultural produce and machinery. Right? So they export fish to the world actually because they do a lot of fishing. So to sustain that export level, to sustain that export competency, they have to reduce their value of currency. Now I am going ulta. To sustain that export or to increase exports, they have to reduce their prices in the export market. To reduce their prices in the export market, they have to weaken their currency. To weaken their currency, they have to strengthen some other currency. To strengthen some other currency, they have to import a lot. To import a lot, they have to raise prices a lot. To raise prices a lot, they have to supply money a lot. To supply money a lot, they have to follow negative interest. Samjha ya nahi? This is the story of Japan. Why can't India follow negative interest rate policy? Because we don't export a lot. Remember, X minus M hardly hai. It is barely 1 or 2% of the demand. 87% is C plus I, remaining 11% is G, and remaining is X minus M. Japan ka more than 50% is X minus M. Just imagine. That is why Japan is following negative interest rate. Did you follow this? So now we will write. You help me write whatever we have discussed. Okay? This was all about negative interest rate regime. What happens? First step, negative interest rates. Second step, higher purchasing power, because higher money. So let's use money supply here. Higher money supply. Next step, higher demand. Next step, higher imports. Next step, price rise. Next step, let's say dollar increases and yen reduces. Next step, export price becomes less. Next step, demand for exports increase. Next step, X minus M increases. Next step, GDP increases. समझा? Samjha? This is the story of Japan. This is the story of negative interest rate policy. When can India follow negative interest rate policy? When X minus M, when we are export dependent. We are now not export dependent. We are self, we import a lot of things, we export few things, because self only we consume so much कि there is very little left for exports. Huh? We are a country of so many people. So हम ही खा लेते हैं सब कुछ. So what is left for remaining is very less. ठीक है? So this is the story of Japan. Now economists have debated over this. This is not that it is not necessary that this would follow. See, what are the negatives of this? Prices are rising, which means more and more proportion of people are being spent on consumer goods rather than investment and savings. See, when prices rise, your savings reduces, because out of 100 rupees salary, you are now spending 20 rupees. Okay? And you are saving 80 rupees. Tomorrow if prices rise, you have to spend 35 rupees for those food and for basic things, and your savings reduces. So that is also a very negative aspect of. And savings bhi kya kare? What will you do with savings? Savings, you go to bank and you keep it in banks. Banks will say, sir, we are following a negative interest rate policy. Take it away. We will not give you any interest. So in Japan, when you save money or when you keep money with banks, you have to pay interest or charges to bank. Just imagine, you have to pay charges to bank to keep your money safe. We get money here, okay? Because they are following a negative interest rate regime. And I am talking about real interest, real negative interest. So nominally they would say 1 or 2% as the interest rate, but really when inflation is taken into consideration, they go back to minus. Okay? Did you understand this? Very important. Negative interest rate policy, very important. It is practiced in the world today live also. ऐसा नहीं कि it is just theoretical or just for academic debates. It is followed. It is debated. No doubt it is debated. But sometimes it is successful, sometimes it is not successful. ठीक है? Now I am going to tell you something which probably is the most important part of today's lecture. Okay, today's monetary policy, whatever we are covering, this is a very important part which I am trying to tell you. So pay attention, pay very close attention here. There are various countries available. There are various countries in the world. Okay, let's say this is USA. Okay, there are various small countries. Let's say this is India, Sri Lanka, UK. I would not write UK here. I would write Bangladesh, Vietnam. Okay, and there are various small countries. Right? Chal. Who is the developed country here? USA. I told you earlier, now this is very important. I told you earlier that for developed countries, for global investors, for people who have a lot of money to invest, these countries are markets. These countries are individual markets. So when they see that India I can start a business or I can invest in a company called Reliance in India, I am a global investor. I can invest in a company called Reliance in India. I can invest in a company called Tesla in USA. I can get more, I can increase my money, I can get good returns. So I will pour money in India and I will invest in Reliance, or I will pour money in India, I will start my own business. Do you agree with this? Very simple, yes or no? So funds flow from USA to Sri Lanka, to Bangladesh, to India, to Vietnam, to other countries. Okay, funds flow. Now is it good for us or bad for us? It is very good for us because we are getting so much of money. We are getting money and we are able to use that money. Now whether to allow that money to go back quickly or not, that is a separate thing. That is a thing of balance of payment chapter. We are not coming here. But did you understand this, whatever I said? Ki fund flows from global investors to all the countries. Yes or no? Samjha ye? Right? Now why are they investing in India? Tell me one thing. Why are they investing in India? What is it that attracts them a lot in India? So India mein, if you open, so they see that India mein, if you open a savings bank account, you will get, let's say 7% rate of interest. Suppose 7% per annum you will get rate of interest. Okay? Simple savings bank account. And here if you open a savings bank account, let's say, here you will get 3%. Which is more attractive now? USA, India is more attractive. So people will pull money from here and put money here. Do you agree with this? Because they will get 7% here, they will get 3% here. Simple, so far, very good. Right? Now, let us assume that who is USA is, you can write afterwards, in the end, at the end of the lecture you can write. Let us assume that who is USA's Reserve Bank or who is USA's central bank? I told you yesterday. Federal Reserve. Okay? And here who is there? RBI is there. Okay? So far, very good. 3% very happy, 7% very happy. Now, why it is 3%? Because they are developed countries and to boost their growth, they want to keep their rates as lower. Okay? Tomorrow, let's say USA faces a liquidity crisis. Let's say USA faces a liquidity crisis. What would happen to the interest rate? Would it increase or would it reduce? It would reduce. So tomorrow, let's say USA reduces its interest rate to 2%. What do you think will happen to global flows? Will more money flow here or less money flow here? More money will flow because now 2%, 7%. Very good. India is very happy. Money is flowing constantly. Yes or no? Money is flowing constantly to India because India has 7%. Why do we have 7%? Because our economic situation is such that we can give 7%. Okay, there is high inflation here, so we are keeping it as 7%, high rate of interest. Right? Now, pay very close attention to what I am trying to say. When USA economy starts to recover, what will happen to the interest rates? When USA economy will start to recover, what will happen to the interest rates? See, these are all individual markets. Money is flowing everywhere. Okay, these are global investors. These take money from USA and give to India because they are getting high rate of interest here. Now, Who will decide whether to reduce or increase interest rates? Federal Reserve. Who decides whether to reduce or increase interest rates? RBI. Let us say we have kept money as it is. Money is flowing here. Very good. We are using that money for our development, for fulfilling our fiscal deficit, etc. Okay. Tomorrow USA starts to recover because this is USA's down. This is USA's down phase. That is why they are reducing interest rates so that they pick the economy up. Tomorrow, when the economy goes up, what will happen? What will happen to the interest rates? Tomorrow, economy goes up. What will happen to the interest rates? Will they increase? Yes or no? They will increase this. Do you agree with this? They will increase this. Okay. Now, let's say average rate of USA economy, average, normally, see this is the down phase. Normal rate of USA economy is, let's say, 5%. 6%. Okay. So if I give you only two pieces of information, one, normally USA interest rate is 6%, but currently it is 3%. What would you think? It is a growing phase or lowering phase? It is lowering phase, because when you are lowering, you reduce your interest so that you get boost. Okay. So when I tell you that normally 6% hota hai, but currently Fed Reserve is going for 3%, which means ki you are in this phase because Fed Reserve is going down. It is trying to pull the economy back up. Do you agree with this? Okay. It is all very confusing. You have to revise it very constantly. Otherwise, ये नहीं समझेगा. This is a very advanced concept which I am trying to teach. अभी वो basic गया दूर. That is over now. Okay. So if I give you only two pieces of information, normally it is 6%, but currently it is 3%, which means that bank is trying to boost growth, which means currently growth is less. So bank is trying to boost growth. Chalo. Now let us say this is successful. Let us say USA's economy is on a recovery phase. After a point of time, we also know that it will reduce, it will have to reduce the growth rate, yes or no, because after that inflation will happen. We know all this. So let's say average is this. Currently it is at 2%. Huh? Currently it is at 2%. How much is the gap now? How much is the gap? 4% is the gap from average. Normal level. 4% is the gap. Okay? How much are they getting here? They are getting a lot. They are getting 5%. Very happy. Tomorrow when economy starts to grow, USA's economy starts to grow. Tomorrow when USA economy prices start increasing, demand start increasing because of low interest rates, what will Fed Reserve do? Would it reduce this further or increase this? It would increase this. Yes or no? So can I say it would start to increase this? Slowly it will start to go towards 6%. Yes or no? हाँ या ना? Simple है. Can I say it will start reducing the gap between these things? 2 है, 6 है. It will start reducing the gap. Yes or no? So this gap is getting reduced. ठीक है? This gap is getting reduced. Now tell me, as the gap is getting reduced, who will be unhappy? Who will be unhappy if the gap is getting reduced constantly? Who will be unhappy? People in India would RBI be unhappy? Yes. Why? Why would RBI be unhappy? Because as the gap is reducing, this flow will start reversing. Do you agree with this? This will go here. People will pull out money from, these are people, global investors only. See, Indians would never invest there unless that rate is more than this rate. Okay, they had come here. They had given their money here. We were very happy when we were using. But when they started, who? Fed Reserve. When Fed Reserve, USA's central bank, started increasing interest rates, who became unhappy? Our central bank. Why? Because now money is flowing out of India. Now money is flowing out of India. Why? Because the gap is reducing. This is becoming less and less attractive. This is becoming more and more attractive. Yes or no? Because ghar pe, if you are getting 6%, why to pay conversion charges into rupees and why to go so much and go there? Where the stability is not so much compared to USA. USA is a very stable economy. India is not so much. Okay? So, when this gap is getting reduced, who is unhappy? RBI is unhappy. Along with RBI, all other countries, central banks are also unhappy because वहाँ से भी money is flowing out. Every country money is flowing out. ठीक है? Yes. ठीक है? Can I say the gap is tapering? English word taper. Tapering means reduction of gap. So mountain is tapering towards the end. Yes or no? So at the base, the gap is maximum between two sides of a mountain. Triangle होता है ना? Triangle also tapers towards the end. So can I say the gap is tapering here? Yes or no? And due to this tapering, who is unhappy? Due to this tapering, who is unhappy? Central Bank of developed countries are unhappy. Central Bank of India is unhappy because money is flowing out. ठीक है? Central Bank of India, RBI saying, hey Federal Reserve, how can you do this? You know, earlier you had shown me good days and now you are telling me this is like British. Earlier you had come and you had done, we are coming for trade, take money and all, and now you are enslaving us. Similarly, how can you do this? How can you raise your interest rates? Fed Reserve says, sir, we are developing, we are also following counter-cyclical policy. Keynes said, Keynes ने हमें भी बताया था क्या करना है, Keynes ने आपको भी बताया क्या करना है, ठीक है? So we are reducing the gap, we are tapering. Who is frustrated now? RBI is frustrated, developing countries का central banks are frustrated. So they started throwing tantrums. कि मैं नहीं, you know, वो हम रोते हैं ना, when we are kids, we start throwing tantrums. I will not go with him. My stomach is paining. Why are you doing this? All of that. So when pay attention, when Federal Reserve started tapering the gap, between the rate, money started flowing out of India. India became less attractive. USA became more attractive. The gap started getting reduced. And when due to this tapering, central banks of developing countries started throwing tantrums. They started saying that Federal Reserve should not do this. Federal Reserve should do it in a very small manner. And this phenomena, very important, this phenomena, very, very, very important, is called as taper tantrums. Did you get why taper tantrums? Because this gap is getting tapered, and who is throwing tantrums? India, RBI is throwing tantrums. Why? Because money is suddenly flowing out of the country back to its origin. This is called as taper tantrums. This happened in 2013 with developing countries including India. This happened in 2013. This is called as taper tantrums. Okay, very, very, very important concept, taper tantrums. ठीक है? This is called as taper tantrums. What happens was, earlier USA rate was very less, so money was flowing here because we have a high rate of interest. It was more attractive to invest in India, but later on, Fed Reserve started tapering the gap, started increasing the interest rate, and the gap was tapered, and due to this, money started flowing out to USA, and then RBI was unhappy, and similarly other countries were also unhappy, and that is why they started throwing tantrums, and this is called as taper tantrums. Tantrums means complaints and excuses or complaints, basically. Tantrums means. Okay, let's move on. Let's move ahead to the next concept. It is very important to know all these concepts by heart. It is very important to understand all these concepts. What is taper tantrums? And so today Federal Reserve is increasing interest rates. You know what is the impact of it. Okay? Today, if the Federal Reserve is increasing interest rate, is it good or bad for the economy? It is bad for the economy because money will flow out. Tomorrow, if Federal Reserve reduces interest rate, it is good for the economy because money will come here. So this keeps on happening on a day-to-day basis. So whenever you read in the newspaper, so remember, we have monetary policy review every 2 months. Federal Reserve also has a monetary policy review. When Federal Reserve ka monetary policy comes, often an article comes in the newspaper, or if they show that they are going to increase interest rates drastically, often articles will say that this can lead to another taper tantrum, or this can lead to outflow of funds. So when you read that Federal Reserve is increasing interest rates, you automatically know that it will result in outflow of funds from India. Yes or no? Okay? This is very important to know because we are also one market after all, right? Now there are few small things which I would like to tell you, few very small things. Okay? So first of the things is, first is called as Seigniorage. This is very small thing I am telling you. What is Seigniorage? Have you ever wondered the cost of printing currency? You have a 100 rupees note. Have you ever wondered how much does it cost to print that 100 rupees note? Have you ever wondered how much does it cost to mint a coin of 5 rupees or 10 rupees? Okay? So whenever RBI So who incurs the cost? RBI incurs the cost of printing currency, and obviously government gives RBI the money because RBI is ultimately under the control of government only. It is a nationalized central bank of India. But so when RBI is incurring a cost, let's say for a 100 rupee note, RBI incurs a cost of 10 rupees. Okay? So RBI is incurring a cost of, see, is RBI not a supplier of notes? Is RBI not a supplier of notes? So for it, printing notes is the output, and raw material for notes, paper and all those security features, they are the input. So if RBI is giving you a 100 rupees note for 100 rupees and uska cost is only 10 rupees or 20 rupees, what happens to that remaining 80 rupees? That remaining 80 rupees is the profit of RBI. Samjha? Imagine RBI is a trader of notes. So that profit which we just calculated, that is called as Seigniorage. Okay? It is the difference between the value, it is the, I will write it down, you can write it later on. Difference between value and cost of currency. Okay, so you should know only this concept as a concept. इसका कोई relevance नहीं है इतना UPSC में, but you should know this as a concept. You should also know that coins are the costliest to produce because they have metal in them and they are almost neck to neck. So 5 rupees coin will be cost would be 4 rupees and 90 cents and 90 paise and 4 rupees and 95 paise. Very little profit happens. Okay? And if it is not less, if it costs more, just imagine if it costs more, then people will start melting the coins and selling the metal. Because अगर 5 रुपए के coin में 7 रुपए का metal है, then you take the 5 rupees coin and melt it and sell the metal for 7 rupees. Simple. It is lesser but very neck to neck है. The more the denomination of the note, 2000 rupees note, the higher the profit, because see ultimately paper तो same है. Only thing is dimension changes, color changes, but other raw materials are same. So the same goods you are selling for 2000 rupees, for 100 rupees, for 200 rupees, but the cost is 10-20 rupees. So profit will keep on increasing in your high denomination notes. Samjha? Just this one thing is important. Second most important thing I like to tell you is how many, what do you think, who all take care of the finances of the country? Government takes care, RBI takes care. Do you think that SEBI also takes care, because capital markets are also an integral part? Securities and Exchange Board of India, it is also a regulator. Yes or no? Government, maybe there are different ministries, finance ministry is there, corporate affairs ministry is there, economic affairs department is there. So there are so many things and so many people who take care of the finances of the economy. Do you think there should be a common platform where these should meet and discuss कि क्या करना है भाई, है ना? There should be a meeting of all these agencies also, na? SEBI, RBI, Government of India. These should all meet in a room and discuss ki how to go about it. So we have such a platform. It is called as, see the name, see English. Financial Stability and Development Council. This was established in the year 2010. Who do you think heads FSDC? Who will sit as a chairperson? Who do you think? Who is the highest authority on economy in India? Finance Minister. Okay? Do you remember the 3 committees who recommended a public debt management agency? Jahangir Aziz Committee, Raghuram Rajan Committee, B.N. Sri Krishna Committee. I told you B.N. Sri Krishna Committee was also called as Financial Sector Legislative Reforms Committee. They also recommended an Indian Financial Code where you have to consolidate all the laws. Yes or no? Second committee which I mentioned was Dr. Raghuram Rajan Committee. Do you remember this? One of the recommendations of Dr. Raghuram Rajan Committee was creation of Financial Stability Development Council. It was immediately approved because that Raghuram Rajan Committee was set up in 2009 and 2010 May Financial Stability Development Council was brought in. Now tell me, we have discussed this in the very earlier lectures. Now tell me, did something happen in 1 or 2 years before 2010? Global economic recession happened in 2008. Global economic recession happened in 2008. Remember I told you, after global and remember that fiscal deficit ka chart which we saw. In global economic recession, deficit went up high because we were spending a lot to save ourselves from recession, and then again we came down. Okay? So similarly, immediately after a global economic recession, we realized that there should be a body where everyone comes and everyone a uniform action is taken, because tomorrow SEBI will say something else, RBI will say something else, finance ministry apna hi chal raha hai alag se, right? Hence this was created in 2010. Hence I always say that whenever you see the year, just try to think कि उसके आगे उसके पीछे कुछ हुआ था क्या? Did something happen before it, after it? ठीक है? Now this was in India. Do you think such a forum should exist on the global level also? You know, where finance minister from India will go, finance minister of some other country would come. So there is one more forum on a global level. There is one more forum on a global level which is called as you should not be confused in these things. These two are very different boards. Nature is similar. Financial Stability Board and Financial Stability Development Council. Financial Stability Board was created in 2009. Why do you think it was created in 2009? Why do you think it was created in 2009? Because of 2008 global economic recession, they felt that on the world level also countries should come together and meet. Who do you think participates from India in Financial Stability Board? Who do you think participates? Achha, this was established by G20. Yeah? Do you remember G20? Group of 20 countries, G7, G20, we saw in the context of BEPS, base erosion profit shifting. Okay. Now, this is in Switzerland. So Switzerland में Basel नाम का एक गांव है छोटा सा. Basel is a village name, and in Switzerland they meet. Who do you think goes from the government side? Who do you think goes from India side? India side से कौन जाता है? Who goes? Deputy Governor RBI. Deputy Governor RBI. SEBI chairperson, and from government, Secretary Economic Affairs, not Finance Minister. Finance Minister goes to G20 meetings directly, not for the Financial Stability Board. So government sends one Secretary of Economic Affairs, one IAS officer or IES officer, Economic Service Officer. SEBI chairperson goes, he himself goes, and Deputy Governor of RBI goes. So highest body of SEBI goes, highest person, second highest person of RBI goes, and an officer level person of this thing goes. ठीक है? Next, quickly we move on to another concept. These are all small things which you should know. Baki majorly to we have completed with the monetary policy chapter. Chal. Now we are coming. I want to show you something, and then we'll close this chapter. Just one important concept is remaining. What do you think? I had told you in the starting of the monetary policy chapter. I had told you what do you think happens when fiscal policy and monetary policy go opposite to each other? Which means, what do you think if tax rates increase but interest rates reduce? Or ulta, what do you think if interest rates increase but tax rates reduce? Samjha? So one is pushing the economy up, one is pushing the economy down. Yes or no? So there will be inflation plus there won't be any growth. Normally, how do we associate inflation? Growth ke uppar aata hai. This is growth. This is inflationary part. Inflation is there here also, no doubt, but this is sole inflation and then it goes down. Yes or no? But what do you think will happen if monetary policy and fiscal policy cross paths with each other? What do you think happens if monetary policy is pushing for growth but fiscal policy is reducing growth? Fiscal policy has increased taxes, which means you are reducing, but monetary policy has reduced interest rate, which means you are increasing. Okay? So what happens is that there is inflation also. Inflation bhi hai, but growth nahi hai. Samjha? Because they are crossing paths with each other. Now, what do you think will happen to employment levels? Would they increase or would they reduce? Employment levels would reduce because there is no growth. If there is no growth, only prices are increasing, but suppliers are not willing to expand their, factories. Okay? They are getting good prices, but they know that growth nahi hai. They know this is not real. It is only inflationary. Okay? It is only inflationary. This is not real, only nominal. So when you know that the prices which you are getting are only because of inflation and not because of real increase in demand, you will not establish a new factory or a second building. You will not employ people. So what will happen to unemployment level? Unemployment level will go up. Yes or no? Unemployment will go up. Employment will go down, but unemployment will go up. Okay? This situation, when there is, so can I say, Can I say growth nahi hai? Employment is also not there. Unemployment is high. Growth is also not there. Can I say that economy is stagnating? Stagnation आ रहा है ना? Yes or no? Stagnation आ रहा है. There is some stagnation because of growth and unemployment का issue. ठीक है? But there is inflation. This phenomena is called as stagflation. This phenomena is called as stagflation. Suddenly we have arrived in the inflation chapter. This is transitioning to inflation chapter. When monetary policy and fiscal policy are at loggerheads with each other, when they cross each other, when they do not agree with each other, then often this is the result. Inflation is happening, growth is not happening, employment is not happening, and stagnation is happening. Now I want to show you something very important. We'll discuss stagflation in detail. I want to show you something. We'll go to India budget, our favorite site. We'll see the speech of finance minister. I want you to read this paragraph and I want you to tell me whether you understood each and every bit of it or not. Okay, I'll show you one paragraph which is important. Okay. Read this paragraph and tell me whether you understood completely or not. The key word here is completely. Each and every word should be understood absolutely with thorough clarity. Paragraph 141. Remember, BE is budget estimate. We had done this BE, RE, revised estimate, actual estimate, budget estimate. Did you understand every word of it? Are we going on the right track? Okay? You might not have understood this monetization of assets that we are going to cover in infrastructure actually. Point number 9, infrastructure, energy, ports, roads, airports, railways, etc. So in point number 9, we are actually going to cover it in a bit. But monetization of assets means nothing but selling your assets. Monetization means selling. So when you sell your mobile phone, you are monetizing your mobile phone. So there is a lot of land with the government which is unused. Railway land, defense land, lot of land ऐसा ही पड़ा है. There is nothing there, no building there, but it is government under government ownership. So government is saying कि instead of keeping it wasteful like this, why not sell it, or why not give it on rent to someone? If you give it on rent, they will use that land and they will pay us rent. So that is monetizing. Monetizing means to generate money out of something. So either you can sell it or you can give it on rent. So that is monetization. Did you understand each and everything? This is the most important paragraph of the budget, this year's budget. Okay? The fiscal deficit in revised estimate is pegged at 9.5% of GDP. We have funded this through government borrowings, multilateral borrowings. Okay, government borrowings, multilateral borrowings, which means from World Bank, IMF, multilateral institutions. Government borrowings, our own borrowings. Small savings funds, remember Public Account of India, Small Savings Fund, National Small Saving Fund, short-term borrowings. We would need another 80,000 crores for which we would be approaching the markets in these 2 months. Remember T-bills, government bonds, SDLs, we would be approaching the market. They are borrowing from the market. If this is more, what will happen? Crowding out will happen. Okay? To ensure that the economy is given the required push, our budget estimates for expenditure are 34.83 lakh crores. This includes 5 lakh crores as capital expenditure, which is increase of 34.5% of. See, you don't need to remember any figure. The point is, did you understand what they are saying? Did you understand their language? Over the BE figure of 21. The fiscal deficit is estimated to be 6.8% of GDP. The gross borrowing from the market for the next year would be 12 lakh crores. 12 lakh crores they are going to borrow from the market. Possibility of a huge crowding out. Yes or no? We plan to continue with our path of fiscal consolidation. Remember fiscal consolidation? And intend to reach a fiscal deficit level below 4.5%. Now 9.5, next year 6.8, and then 4.5 by next 2-3 years, 25-26, with a fairly steady decline over the period. We hope to achieve the consolidation by first increasing the buoyancy of tax revenue. Remember, buoyancy of tax revenue, increase more than proportionate increase in tax compared to increase in GDP, and increasing the tax revenue through improved compliance, and secondly by increased receipts from monetization of assets, including public sector enterprises and land. So even public sector enterprises have a lot of assets which are aise pade hai, so sell them. The contingency fund of India, I told you this, is proposed to be augmented from 500 crores to 30,000 crores through finance bill. Did you understand the entire this thing? They are talking about fiscal consolidation, they are talking about tax buoyancy, they are talking about monetization, they are talking about borrowings from market, they are talking about fiscal deficit, they are talking about capital expenditure. So many terms are here in this paragraph. Yes or no? So it becomes very critical for us to learn all these, revise all these concepts, and then only we will be able to read this. Samjha? Now I will take you through one more thing. I want to show you the index. See this. Let us quickly go through these 3 chapters. Just we'll go through them whether we understand these 3 chapters or not. Fiscal developments, external sector, except balance of payments, and monetary management and financial intermediation. Okay, I want to show you a few things about this, not more. So we'll do fiscal developments now. 52. इसका वो किधर है? ठीक है, let us read this. This is very important. In the backdrop of an unprecedented crisis, the year 2021 has been a challenging one on the fiscal front. Shortfall in revenue collection owing to the interpretation in economic activity and the additional expenditure requirement to mitigate the fallout of the pandemic on vulnerable people, small businesses and the economy in general created immense pressure on the available fiscal resources. So far so good. In order to cater to increased demand for resources, target for gross market borrowings of central government was revised to 12 lakh crores. We know this. In India therefore adopted a calibrated approach best suited for evolving situation of the economy in contrast to front-loaded surge. See, this is all fine, this is very general. Do we understand what is capital expenditure, revenue expenditure? Okay. The recovery in GST collection has been due to combined effect of rapid economic recovery post-pandemic and nationwide drive against GST evaders and fake bills. So you increase your compliance and you increase your collection. Okay. Then, do we understand all these? Let me know. What is assignment to states? Remember devolution. You devolve your tax and then net to center. Bacha kucha, net. Okay? So gross I received this much. Some percentage of it I have to give it to states. Net I have this much. Non-tax revenue, non-debt creating, debt receipts, total expenditure, everything is known. Okay? Very good. And you know these paragraphs that we are skipping, they only explain this table only. So उसमें कुछ नया नहीं है. Same thing it is mentioned here. Right, then we go to this. Do we know subsidies will cover in agriculture? So now we don't know this. Okay, then see this. What is written? Like this summarizes our discussions on fiscal policy. Yes or no? What are they saying? Adoption of counter-cyclical expansionary fiscal policy in times of crisis is expected to boost the growth in GDP. How? Directly and indirectly through multiplier effects. Remember I told you one action multiplier effects on private consumption expenditure. What they are talking about? C. And private investment. What they are talking about? I. Higher GDP growth to thereby facilitate buoyant revenue collection, means higher than proportionate revenue collection in the medium term and thereby enable a sustainable fiscal path. So when your revenue is buoyant, you can consolidate your fiscal policy. Yes or no? You can reduce your fiscal deficit. So thereby sustainable fiscal path. Dekho. This is fine. This is very advanced. So we don't need to go here now. See, these are the stimulus measures. Fiscal stimulus we tell na ki how to provide fiscal stimulus. So agriculture ko itna diya, demand boosting, liquidity support, livelihood, all of this is given in survey. It is very interesting document. You have to read next year's survey. This is current year survey. This survey will come, like for you it will come on 31st Jan 2022. So you have to read it and we'll go through it together because it's very interesting. And at that time I will not sit and explain, oh, do you know what is fiscal deficit? I will assume you know all of that. That is why you have to revise all these things. Okay? Reforms in tax administration. Remember we discussed about faceless assessment. Okay, सब same है यार. They have given the entire faceless assessment का procedure here, which is not required for us actually. Faceless appeals, remember? Faceless appeals. One more thing I want to show you before we close this. इसलिए I am just scrolling. This is all tax related. Remember we did taxation chapter also. So you will find a lot of government data and government measures for tax here. Central government finances, effective revenue deficit, primary deficit, fiscal deficit. Do we know all these things? Yes, we know all these things. ये तो same है. Non-tax revenue and all of this. Growth indicators they have given. Trends in receipts, tax revenue. What is this? Gross tax revenue. Indirect taxes 45%, direct taxes 55%. But now I told you they are neck to neck. Okay? What is this? Corporate income tax. What is this? Union excise duty. What is this? GST. What is this? TOI? Taxes on income other than income tax, basically corporate tax and income tax. And what is C? Customs. Okay. What about non-tax receipts? Grants, interests, others, fees, fines. What about non-debt capital receipts? Disinvestment, mainly disinvestment. So these are, see, revenue expenditure, defense, subsidies, interest, pension, salaries. Did we do all this? Yes. नया कुछ नहीं है इसमें. So we'll transfer to states. We are yet to cover transfer to. See this. This is what I wanted to show you. Finally, after a long journey, painful journey. Read this. Central government debt. Read this. We are reading economic survey in foundation lectures. इससे ज़्यादा better क्या हो सकता है? Total liabilities of central government include debt contracted against Consolidated Fund of India, technically defined as public debt, as well as its liabilities in the public account. Yes, we did all this, two types, public debt and public account. These liabilities include external debt, end of the financial year at current. Sorry, that is fine. Total liabilities was it out of this 88 was of public debt and remaining 10% to public account liabilities, including small savings funds. And these are other funds, provident funds. I told you, na, PF and all. I had given you examples. See this. A public debt, A1 plus A2 means two components. What is two components? A1 internal debt plus A2 external debt. Remember, internal, external. Now A1 is A plus B, marketable, non-marketable. That is fine. And then B is public account. And what is EBR? Did we do extra budgetary resources? Did we do EBR? Revision. We have done EBR. I had told you what is extra budgetary resources. Think and tell, take 2 minutes, but think and tell. What is extra budgetary resources? EBR. Extra budgetary resources are borrowings of public sector banks. Remember, public sector undertakings. Remember, I told you when government cannot borrow, what it does is it tells its children that you borrow and I will use. Remember, extra budgetary borrowings or extra budgetary resources, EBR. So EBR is 1.1. This is not calculated in the deficit. Remember, okay? Then see this center's debt to GDP ratio. What was NK Singh committee recommendation? 40% for center hai na, 60 total. So it is around 46 to 48%, which will go up now because of extra borrowing. Remember, 12 lakh crores it is going to borrow in this year. So this will go up. This NK Singh committee had said to reduce to 40%, right? See this, central government debt is characterized by low currency and interest rate risk. Remember, currency risk we spoke about. So if your debt is denominated in rupees, then you don't have any currency risk, right? So low currency and interest rate risk. This is owing to low share of external debt in the debt portfolio and almost entire external borrowings being from official sources, which means being from World Bank, IMF and official government sources. Okay? Further, most of the public debt has been contracted at fixed interest rate, making India's debt stock virtually insulated from interest rate volatility. I taught you fixed and floating interest rate. Floating interest rate carries a risk. So they are saying that most of the debt is fixed interest rate, which means globally interest rate might go up, go down. We don't care. We are fixed. This leads certainty and stability to budget, yes or no? Because we know how much we have to pay revenue expenditure in terms of interest. Okay? Then same thing goes for state finances. See this. What was the state target for debt to GDP? 20%. 40 center, 20 states. 26% hai abhi around. And this will also increase no doubt due to COVID. But then NK Singh committee said that this you should reduce to 40%. ठीक है. Same thing is repeated for state, so I don't need to go there. See this I was telling you. I just saw this. कहाँ गया यार? See this. 50 BPS. What does it mean? What does 50 BPS mean? How much percentage? 0.5 percentage. 100 BPS is 1%. So 50 BPS is 0.5%. Okay, I just saw that, so I thought ki, this is what we study. This is very advanced concept. We don't need to go here now. Chapter over. Finish. Okay. So did we understand majority of the chapter? At least the terms used in the chapter. See, we are not going into analysis. We have not gone into specifics of it. But majorly, we know what is included. Majorly, we know what is क्या बोलते हैं? What are the terms being used? What are the concepts being used? Okay. So coming back to stagflation, what is stagflation? Very simple. Tell me what is stagflation? Stagflation is stagnation plus inflation. Is stagflation. Why stagnation? Because growth is not happening, employment is not rising. But why? But then inflation is rising. So why is inflation rising? Because one of them, either monetary policy or fiscal policy, one of them are following a policy which is counter to the another. Okay. So that is when stagflation happens. But also remember that why are they following this? Why are they going at opposite to each other? Because they feel that this is the beauty of economics, because one thing can be interpreted in two ways by different people. So if government says that this much growth is not enough, we need to boost growth, RBI says that it is more than enough. Okay? This is the judgment call. This is a very good judgment call. Now tell me, how can you come out of stagflation? Very simple. How can you come out of stagflation? You have to increase growth. Yes or no? How can you increase growth? By increasing your real output. Remember real output? Real output has to grow. See, because inflation is there. Nominal growth hai. Nominal growth is there. Real growth is not there. So real output you have to increase. And when you increase real output, then you will obviously provide employment to people, and then you will come out of stagflation. Now think ulta. Now think reverse. Due to real output not increasing and unemployment reaching high, you will reach stagflation. Okay, so it is not only due to the opposing policies of RBI and government. I just gave an example. When RBI has or a monetary policy goes opposite to fiscal policy, then stagflation may result. But the major reason that always this happens is when there is no real output growth or very less real output growth, but inflation is very high and unemployment is very high. Like employment is not being created, employment is not there. Okay, that is when stagflation happens. This is all about stagflation. And by the way, welcome to a chapter which we call that inflation. So I give you my blessings to cover monetary policy chapter from reference books. Okay, you can read till now. You can read basic chapter, introduction basic chapter. You can read fiscal policy chapter. You can read monetary policy chapter. You can read taxation chapter. Okay, after inflation, you can read inflation chapter also. Right? Money supply, in some books it will be together with monetary policy. In some books it will be different from monetary policy. We will be covering money supply in 1 hour. It will take 1 hour. Maybe this lecture or next lecture or somewhere in the next 2-3 lectures we will be covering money supply or all about money. Okay? But first I would like to start with inflation because I like this chapter and it's a very simple chapter. It will get over within, I don't know, 1 hour, 1.5 hour mein it will get over this chapter. Okay? So welcome to inflation. I told you one of the most complicated concepts of inflation, which is stagflation. Do you understand why stagflation happened? Did you understand what is the reason for stagflation? Because there is no real output growth and there is no employment growth. Unemployment remains high, growth does not happen, but inflation goes up. Okay? Now why inflation goes up? That all we are going to see here, yes or no? And inflation goes up, and that is why we call it as stagflation. So let me start inflation chapter formally. Okay? Now what is inflation? It is very important to know what is inflation and what is not inflation. Okay? There are two words which I would like you to know. What is inflation? See, if I ask you what is inflation, what would you say? Rise in prices. Mengai. Mengai is the perfect word for it. You know, rise in prices, increase in prices, that is known as inflation. So there are two words which you need to know, that any rise in price is not inflation. Always remember, any kind of rise in price is not inflation. It is what? Inflation is what? It is a persistent rise. The first word we saw is persistent rise. It is what? Persistent rise. Persistent means what? Constant, not at the same rate necessarily, but increasing. So today it will increase at 2%, tomorrow it might increase at 1%, then it will increase at 4%, then it will again increase at 2.5%. That is okay. But persistently you are studying. Okay? Every day you might not study 10 hours, but you are studying for 8 hours, 10 hours, 11 hours, which means persistently you are putting in hours, not exactly the same amount of hours. So similarly, it is not same or constant increase, but constantly increasing. Are you getting the difference? Increasing is not at the same rate, but increasing is constant. कि increase हो रहा है, increase हो रहा है, ठीक है? This is persistent rise in what? In prices, ठीक है? But what prices? Persistent rise in second word, keyword of the definition. This is useful for mains. Huh? Prelims, nobody is asking you this. Average prices, persistent rise in average price. It is rhyming. Persistent rise in average prices of goods and services. Do not forget services. We always take examples of goods. We always take examples of hard machinery, capital goods, intermediate goods, all of these goods when understanding a lot of concepts, right? But the same concepts are applicable, same concepts are equally applicable to services also. So imagine you go to the doctor, he charges you 400 rupees. Tomorrow he charges you 500 rupees. Day after tomorrow 520 rupees. Then again 580 rupees. Then 700 rupees. Persistently his price is increasing. Yes or no? Average price is increasing. Yes or no? And that is when inflation is happening in services also. Samjha? ठीक है, very good. See, inflation में there are, what do you think UPSC can ask in inflation? Either it can ask something about types of inflation and what causes inflation. Okay, so it will give you in prelims, if I tell you, it will give you 3-4 options and it will tell ki what causes inflation. So 1 and 2 only, 2 and 3 only, 1, 2, 3, all of them cause inflation. In mains, what can it ask? In mains, to be very honest, one single question on inflation is difficult. It might come, but the probability is less, but it will come as a part of a bigger question. Okay, so now inflation, if you're reading the newspapers, you will come to know that inflation is at the peak. Since 30 years, we are facing the highest inflation. Just imagine. Since 30 years, after 1991, we are facing the highest inflation. So why is that? We'll see all of that. And then I will show you one article which is so high level, but you will come to know what it is talking about, and then you have to clap for yourself, okay, when you are able to read it. After we complete the inflation chapter, I will show you that article, okay, right? I know the heading also of that article, so we'll search that article online and then I will show you that article, right? Chalo. Persistent rise in average prices of goods and services is called as inflation. Do you agree with this? Do you agree with this? It's very simple. Persistent rise in average price of all goods and services is inflation. Okay? Now, what do you think causes inflation? क्यों हो सकता है? We come back to demand supply. Remember demand, supply. This is the equilibrium price. Now, when will prices increase? My question is, when would prices increase? When demand reduces or demand increases? Demand increases. When would prices increase? When supply reduces or supply increases? Supply reduces. Okay? So we know that inflation can happen due to demand rising and inflation can happen due to supply reducing. Yes or no? Samjha? So far so good. Are you understanding all of this? Why would demand increase? Why would demand increase? There are various reasons why would demand increase, but what do you think? Why would demand increase? Why do you demand anything? Why do you think demand increases? You only tell. If you did not buy something yesterday, you are buying it today, or you see that many people are buying it today. Why do you think it happens? Why do you think? Think and tell me. Maybe a new advertisement which comes for a new product which you like. You are going on a metro and there is a nice ad of Lenovo laptop or anything which you like. Okay? Or a new clothing brand. Okay? You see someone wearing, some model wearing jeans, and so you also demand that kind of goods. Okay? Right? So demand rises. What are the other reasons? One is advertisement. What is second reason? Advertisement में सब आ गया, even if Shahrukh Khan is wearing some particular brand, that is all advertisement, that is all model influencing and all of that, that is all coming. What is the second reason? Simple, we have done fiscal policy, monetary policy, what are you doing? When will demand rise? When people have more purchasing power. When would people have more purchasing power? When fiscal policy is expansionary or contractionary? Expansionary. When taxes reduce or taxes increase? Taxes reduce. When monetary policy is cheap or monetary policy is dear? Cheap monetary policy. When money supply reduces or money supply increases? Money supply increases. When SLR reduces or SLR increases? SLR reduces. ठीक है, समझा? Very simple. So demand increases due to so many things. ठीक है? Demand can also increase due to nature. बारिश आ रही है, छाता. It is raining, everyone demands umbrellas. So can I say seasonality is also one of the factors. ठीक है? Then let's say now there is a, do you know at this point of time there is a big heat wave going on in USA and Canada. Temperatures are reaching as high as 55 degrees Celsius. We are not back, we are at 47, don't worry, we are at 46, 47. हम पीछे नहीं है, but this is usual for us. For a place like Canada to have 50 degrees, just imagine, Kashmir mein 50 degree, it is like that, 50, 55 degrees. It is heat wave. So now what do you think, people will demand more ACs or less ACs? More ACs. Now ironically, ACs contribute to global warming, which contribute to warming, but that's a different thing, that is for the environment. So demand increases due to various facts. Okay? Do you agree that supply also increases due to various reasons? Okay? Right? So demand increases, supply also increases, supply also reduces, no doubt. These are the major causes of inflation. Do you agree? Basics se hum start kare. We are starting with basics. One level we will go up. So I will not start by telling you inflation targeting directly. Then we link with monetary policy and all of them. Okay? So what I'll do here is I'll stop here now. I think we are about time. I'll stop here now. I'll give you some 2 minutes to write each of these slides, and then I'll stop. I will save this also. If you have not written, then you can pause and write. But I will give one minute to each slide. You write this down, and then we will continue with this chapter afresh in the next lecture. But I hope inflation, you get the idea of what is inflation. It is the average price, persistent rise in the average price of goods and services. Okay? So we started with monetary policy. We ended with monetary policy also. That is also a good thing that we did. So this, so you don't need this one dilemma. I hope you know what is this dilemma: growth versus price stability, inflation. That is the constant dilemma between which is faced by governments, which is faced by RBI. ठीक है? Right? What is the next slide talk about? This you take time to draw this if you haven't already. I'll give 1 minute. If you take more time, you can pause it. But I'll just wait for a minute so that you can draw this. This is very important. What is quantitative easing? What do you think is quantitative easing? Unconventional methods used by RBI. Please write this word down also. Unconventional methods used by RBI. Okay? It is unconventional methods used by RBI. This is very unconventional. Unconventional methods used by RBI. Right? So what happens is, we are in a zero lower bound situation. We are in a near zero situation, but still growth is not happening. What we do is we go for unconventional methods. Open market operations, accepting lower grade securities, one of them. Printing currency, which is also known as helicopter money, is also one of them. And then we try to boost economy. Monetary policy becomes ineffective here. You should know this. This statement can come कि in a zero lower bound situation or in a near zero interest rate regime, which policy is ineffective, fiscal or monetary? It is monetary policy which becomes ineffective, because this we are talking about interest rates. है ना? Tax rate are still 30%. You can tomorrow reduce tax rates and you can boost. But here we are talking about monetary policy becoming ineffective. Right? Then we spoke about negative interest rate regime, and we spoke about Japanese experience altogether. What is the linkage? Yeah, I hope you remember the linkage. What happens is, Japan follows negative interest rate policy, which makes it easier for banks to give out all the money, and banks discourage people from saving money. They say कि you spend. When they spend, demand increases, price increases, inflation happens, demand for imported goods also increases. When demand for imported goods also increases, you have to pay in dollars, you only have yen, so you give more of yen and you get more of dollars. So dollars are in demand. Dollars value increases, yen's value decreases. When yen's value decreases, your own goods in the world market fetches less price, which increases demand for your goods, and then you can sustain your economy based on exports. Okay, it's a very interesting thing to read, and you wouldn't have imagined when you started this that you will come to know that there are negative interest rates also. ठीक है, पहले तो interest rate क्या होता है वही नहीं पता था, but this तो I hope you know it is fairly simple, so I'll just skip this. Growth, savings, inflation, everything is directly correlated with the rise in inflation. ठीक है, then this you only have to write one thing, real plus inflation is nominal. बस इसमें और कुछ नहीं है. There is nothing in this. It is real plus inflation is nominal, right? Then we'll go to this. This I'll again give you 1 minute. If you have not written yet, please write this down. This is very important. Okay, this we spoke about now, the flow. But again, keep it in mind that this is not always a rosy picture. People suffer because of this. People of Japan suffer. Japan has been often criticized for following this. Right, you can pause here if you want. I will go ahead. ये तो you have to write in your own words. This is your own creativity. We are talking about taper tantrums here. This is your own creativity. Money flowing in, money flowing out. Right? Tapering of gap between the average rate and the new lower rate. Why lower rate? Because economy is not growing. USA ka. Okay? So I'll again, if you want, you can pause now and I'll go to the next screen. Same thing, if you want, you can write this, you can pause this and you can write FSDC, FSB, Seigniorage, and you can pause here and I will move ahead. This तो we are going to cover again, stagflation, so don't worry about inflation. Inflation तो वापस cover होगा. Right, inflation तो we have just started, we have just introduced. So I'll stop here and please keep on revising. And in the end, I would like to ask you one question. One very important question in the end is, okay, if crowding out happens, what do you think will be the impact on GDP? What do you think will be the impact on GDP? That is the question for homework. Please let me know whatever you can think of, whatever linkages, whatever logics you can use, what will be the impact of GDP due to crowding out. ठीक है, चलो, we'll stop here. Thank you very much. I'll see you in the next lecture. Next lecture inflation खत्म, next lecture inflation over. उसके बाद we will either do fiscal policy का one part which is remaining, or money supply or banking chapter. So all of them are very important. So please see all the lectures diligently and revise all the concepts. These are all heavy lectures, and 2 hours mein you learn a lot, right? And once you keep on reading, and then you'll realize it is nothing but very easy. Okay, thank you so much. I'll see you in the next lecture.